Hi, everybody, and welcome back to Chapter 10, video number 3. When we left off, we were looking at updating our initial assumptions regarding depreciation. And in this example, General Motors purchases some machinery at an original cost of $90,000 on January 1, 2020. It estimates a 20-year life with no salvage value. However, on January 1, 2025, 5 years later, GM estimates that it will use the machine for an additional 25 years. Its total life, therefore, is going to be 30 years. We've already depreciated 5 years, and then plus the additional 25 years here instead of 20. So, depreciation has been recorded at a rate of 1/20th of $90,000 or $4,500 per year by the straight line method. On the basis of the 30-year life, however, General Motors should have recorded 1/30th of $90,000 or $3,000 per year. It's therefore overstated depreciation and understated net income by $1,500 for each of the past 5 years, or a total of $7,500. So here it is per year, the $1,500 excess depreciation charged, and then for 5 years, 5 times $1,500 or $7,500. Okay, so in the previous discussion, what is the book value at the time it changed the estimate in the machinery's useful life, and what journal entry would you make to record depreciation in each year following the change in estimate? Of course, recognize we're not going to go back and make corrections to prior years. So what we do is we start with the $90,000. We subtract out $4,500 times 5 years, or $22,500. Our book value at January 1, 2025 is $67,500. Now we have 25 more years of depreciation. So we take the $67,500 less the updated salvage value, which in this case is 0, and divide it through by 25 years, and that gives us $2,700 per year. So the journal entry for the remaining 25 years using straight line depreciation is going to be a debit depreciation expense, $2,700, and a credit to accumulated depreciation dash machinery, $2,700. Okay, so here we're going to take a look at the Griffith Company, and it purchases some machinery for $106,000 on October 1, 2025. It estimated that the equipment's going to have a useful life of 8 years, a salvage value of 6,000 years. Estimated production is 20,000 units. Estimated working hours are 10,000. Okay, during 2025, Griffith uses equipment for 800 hours, and the equipment produces 2,000 units. So we're going to look at 5 scenarios here: straight line depreciation, units of output, working hours, sum of the year's digits, and double declining balance. And then under Bravo here, at the beginning of 2027, Griffith determines the equipment will have a remaining useful life of 10 years with a salvage value of 0. Assuming the use of straight line depreciation, what's the journal entry to record that depreciation expense in 2027? All right, so under Alpha, we're going to look at the straight line first. We take the acquisition cost of the asset, subtract out the salvage value, divide by the number of years, 8. So it's going to be 12,500 per year. In the first year, it's going to be 3 months of that. So we just take 3/12 of 12,500. Then in 2000, for units of output, here we had 2,000 units. And so again, we're going to take the acquisition cost minus the salvage value divided by the total units of output of 20,000. And that gives us $5 per output unit. Then we multiply that times the 2,000 units that we actually produced times that $5 that we just calculated. And that gives me $10,000. Okay. For working hours, the approach very similar to number 2. We're going to take the acquisition cost minus the salvage value, this time divided by the total working hours of 10,000. That gives us $10 per hour. We actually worked 800 hours times $10. That's $8,000. Some of the year's digits, we need to go 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. That equals 36. And so now I can just ratchet down times the $106,000 here. I think there's a typo there. Oh, I'm sorry. This is the 106,000 minus the 6,000 salvage value here. Okay. And they've divvied it up here between a quarter of a year and 3/4 of a year, quarter of a year, 3/4 of a year, etc. They staggered that through. I think you can follow that arithmetic without my help. And we'll go from there. Next, the double declining balance. Here, 1/8 times 2, 1/8 is 12.5%. That would be your straight line depreciation rate. 12.5% times 2 is 25% using double declining balance. So we start with the acquisition cost here, not adjusted for salvage value, and we multiply that times 25%. We'll take 3/12 of that and adjust book value. And away we go with the same calculation methodology. So to calculate the book value at the end of 2026, we started with our acquisition price. We had 12,500 plus 3,125 that we previously calculated, and that gives us 15,625. So the book value of the equipment at that time is $90,375. Now, to calculate the revised depreciation expense, here we're going to take the book value minus any revision to the salvage value divided by your remaining useful life. So the salvage value didn't change, it's still 0. So we'll take the 90,375 divided by the 10 remaining years, and that gives us a revised depreciation per year of $9,038. So our journal entry, pretty easy here. Debit depreciation expense, $9,038, and accumulated depreciation dash equipment, $9,038. All right, let's look at our next learning objective. Here we're going to be identifying the accounting issues related to asset impairment. Okay. What are events that might lead to impairment? A significant decrease in the fair value of an asset. Significant change in the extent or manner in which an asset is used. Significant adverse change in legal factors or in the business climate that affects the value of an asset. Accumulation of costs significantly in excess of the original amount. And lastly, projection or forecast that demonstrates losses with an asset. All right, how do we measure impairment? Number one here, we're going to review the events or changes in circumstances for possible impairment. If the review indicates a possible impairment, we need to apply the recoverability test. If the sum of the expected net cash flows from the long-lived asset is less than the carrying amount of the asset, an impairment has occurred. Now, if that has occurred, the impairment loss is the amount by which the carrying amount of the asset exceeds the fair value of the asset. The fair value is the market price of the asset or the present value of the expected future net cash flows. Okay, let's look at an example. Here, the ALU Incorporated has equipment that, due to changes in its use, it reviews for possible impairment. The equipment's carrying amount is $600,000. ALU determines that the expected future cash flows, undiscounted from the use of the equipment and its eventual disposal, to be $650,000. The asset has a fair value of $525,000. At what amount, if any, would you record an impairment on ALU's equipment? First, you would apply the recoverability test. The sum of the expected undiscounted net cash flows, and that was $650,000 given in the problem, and it's greater than the carrying amount of the asset, $600,000. So no impairment has occurred. Therefore, it does not need to recognize an impairment loss. Now, under example 2, same facts, except that the expected future net cash flows are $580,000 instead of the previous example's $650,000. Now we have a situation when we apply the recoverability tests, the $580,000 future cash flows is less than the carrying amount of $600,000. So we can then conclude an impairment has occurred. So now we're going to have to record an impairment loss. So the carrying amount of the equipment is $600,000, but let's go back to the problem. The fair value was $525,000. So we subtract the fair value of the equipment given in the problem from the carrying amount of the equipment, $600,000, and we get a $75,000 loss on impairment. What do we do with that? We're going to debit loss on the impairment for $75,000. That's going to hit the income statement. And we will increase the accumulated depreciation dash equipment by that same $75,000. So following the impairment then, the assets carrying amount of $525,000 is calculated here, right? And we've taken the carrying amount down to $525,000, which is, of course, the fair value. So after the impairment journal entry, the updated carrying amount equals the fair value. Okay, that looks like a good place for us to stop this video. And when we return, we'll look at how we disclose an impairment. Until that time, bye for now.